Good morning, all. I hope you are well. So, I have three pairs on watch today, and those are Aussie Kiwi, Kiwi Dollar, and Kiwi CAD. So, Kiwi Dollar and Kiwi CAD are back on watch, and I've just taken just to touch on it while I think of it. I've just taken West Texas Oil off of watch because yesterday, if you watch my videos regularly, you'll know I was looking for an entry down here. It kind of got invalidated by news, I believe. Now, when you see price action such as this, so when you see the impulse down and then you see a sharp move up like that, sharp move down, that is just price action that needs to settle. Okay. So rather than trying to look for a trade here, this is where people will take many, many losses within this area here. This could turn into all kinds of stuff. It could turn into something like this, and then that would be a larger correction, which would be a bit disproportionate relative to the move down, which would imply that we may get something like this, and then this becomes the middle section, okay, which taps into there. We then push up, and then potentially this taps into one of these highs here. So, for example, that high, okay. So this is the kind of trade where you just leave it a kind of setup. You just leave it alone. This would be an example, in my experience, of uh, not so much a high risk trade because you'd probably be able to get your risk off the table to here, but a kind of low quality setup because this is not typically the setup that would play out to the downside aggressively. We would usually get something more like this. So when I see unsettled price action such as this, maybe it's difficult for some of you to understand what I mean, but when you get it's we want settled price action. We want, nice low momentum candles, and that gives us a clue this is just the bigger players stacking their orders for the next wave to the downside. So sharp move up, a sharp move down, sharp move up like that. Just leave it alone, let it settle, let price do its thing, and let people basically hang themselves in here that are going to buy and sell this and just be tagged in and tagged out multiple times. So happy to just leave that alone at the moment. News often does that, which is why we don't trade through the news. Certainly not the red flag news. So Aussie Kiwi, let's break these pairs down for you. So you can see that we have on the higher time frames, we have this high here that was tapped into. So we have the impulse down followed by the correction. We have a series of near misses to this high. We then come back and tap into the high. As I've said, usually we break above if we're going to rally to the downside. So that is a factor in my thinking, but it doesn't happen all of the time. Nothing happens none of the time, and nothing happens all of the time. But one of the clues that we were likely going to move to the downside from there is we had this structure here, where we had an impulse, a more corrective middle section, which also had structure in it. Okay, although Aussie Kiwi can look messy on the lower time frames, the higher time frame structure is often very clear. And then we see that. So we have the 1, 2, 3, this 1, 2, 3 wave move that taps into the area that these highs near miss to. So it's no surprise that we get a very aggressive sell-off from there. Okay, so just building the picture from the higher time frame down. So at this moment in time, there's not really any need for us to come all the way up to here. However, what price could be doing is it could be coming all the way up to here to take out this high, which this high near missed to, and then this would be an impulse correction continuation to take out this low here, which near missed to here, and this low here because this low near missed to it. However, this would be quite wide relative to the move down, which actually means that if we did push to the upside, it's more likely that we would create an M style pattern such as this or a W style pattern to tap into this high again. Okay, but you also have to factor in the fact that this is Aussie Kiwi, and Aussie Kiwi does tend to correct sideways for longer than some pairs. So this overall correction here would not necessarily be disproportionate to the move down by virtue of the pair that we're actually trading. As I drill down, you can see we're kind of stalling in the right area. You can see that there was the start of this candle here. We come back up, we kind of near miss to it. You can see that even on the weekly. just by virtue of these wicks. And then you can see that we're pushing back up. We have a kind of low momentum candle. Okay. And if we just, you can see these rejection candles here, multiple wick rejections just below this area of value where there was a sharp sell-off, and where I would anticipate, if we react from that area, another sharp sell-off to potentially come down to give us this 1 2 3 reversal structure into this low here, particularly because it was sharp. Okay, price will likely find its way back down to there, and if we react from that area, we would likely get that structure to take out this high, which this high near missed too. So just looking to really play from here to here, okay, to capitalize on that move potentially. And if we just zoom out, you can see we even have a reversal structure at the top of what is potentially, an inverse reversal structure to the upside. You can see that we have this kind of structure here, okay, where we have the move up, which is more impulsive than this corrective move down. And the second touch usually breaks above the first. Well, it always breaks above the first, but the second touch usually near misses the area of value, which it did there. So I'm just seeing this as a push up to take out this high, which near missed to this area of value, to give us that completed structure for that move to the downside. And you can see there we have the impulse, a more corrective move up overall, and then potentially a more impulsive move down to complete this structure. So structurally, this is very clear. Okay, at least at the moment, things can be invalidated very, very quickly in trading. And then a lot of people that are not neutral in the moment go, what happened? What? I don't understand. Well, the market can do anything at any time. It doesn't need to confirm to your bias, no matter how many confluence factors you actually stack. So what I'm going to be looking for here is, given the size of this structure, okay, and we do have to factor in things like we've kind of broken out of this, okay, and gone into a new structure. That is something to be mindful of, because often when that happens, this can be a move to the upside, and this ends up being a running channel, okay, because it's broken out of the previous structure. What I'll be looking for is price to tap into this area of value. You can see we've kind of near missed to it again, but we're moving down correctively, suggesting that we might get an impulse up to tap it. And if we do, I'll be looking for a push back in, a minimum of a 5-minute continuation. So a 1 hour push down, 6 to 8 corrective 5-minute candles, just to confirm that we're not moving to the upside for the reason given. And then I would, or if we got that, then I would take the entry on the break. If we got the 15-minute continuation, so 6 to 8 corrective 15-minute candles, then I would drop to the 5-minute chart to see if the 15-minute consolidation was structured on the 5-minute chart. And if it was, I would look for what we call a risk entry within it. So after the two bottoms have formed, we would have a 10 pip stop loss, just because that's the minimum that we go to. And if it wasn't structured, or I couldn't get the risk entry, so we didn't come up to test the first top, then I would just set a reduced risk entry order on the break, and then I would be able to manage it down to here as a first target, there as a second target, and then in this instance, I would trail my stop loss. I would set a take profit here. Okay, so we measure from range to range. The 90% rule is often where we pull back steeply. In fact, I would set a take profit just above, so 90% of the range from here to this low that we near missed to, and then I would trail my stop loss accordingly, and that is what I'm going to be looking for from, whoops, I've deleted the wrong thing there. Wait a minute, let's get that back. There we go. So that is Aussie Kiwi. That may shape up by the end of the day. That's potentially looking the closest to shaping up out of the pairs which I have on watch. So I'm just going to move on to Kiwi dollar. So I said in, what was it, Monday's video, I believe, if you give something an extra 24 hours, often the structure looks a bit more clear. Well, that's the case in Kiwi dollar. I believe it's taken an extra 24 hours to shape up than I was anticipating. But as I said, we don't know how long things are going to take, and we don't even know if they're going to shape up. All we can do is look at the patterns that have repeated themselves over and over again, make educated guesses, and then execute accurately and accordingly if those entries actually shape up. So on the higher time frames, we have a near miss to here, but I'm not so worried about that because of how much of this leg from here all the way up to there, how much of that we've actually retraced. So once we've retraced, more than 50% of the move, and we're kind of trading well below that red line, you can see we're about 75% of the way back from that move from here to here. I'm not worried about this near miss to here. Okay, if I'm looking to get short, because that's just too far away. Okay, so we have here, we do have a near miss here to here, but we also have a structural move down. Okay, so we have this kind of this area of consolidation there. We kind of scoot back up, just seeing this as kind of one touch within this overall structure. We break above, push to the downside, and then as we drill down, there's little structure points along the way. So there's this area here, the sharp move followed by sharp move up, followed by a sharp move down. We kind of don't really react from anywhere. We kind of break some distance above that and end up closer to here than we do to here before we react. But the confirmation was the fact that we impulsed back below here, okay, and then corrected underneath it. That was the confirmation that we would likely push lower from there, which is what we did. And if you can see price consolidating here at the moment. Okay, so if we just drill down, this is a little bit more clear on the 4-hour chart. So after we broke this structure, okay, wasn't the cleanest, but price came down, retested the back end of that and left a footprint. We then came back up, kind of near missed to this high, came all the way back down, near miss here to here. We then break above, we then tap into this footprint by way of a reversal structure, and then we started moving down correctively. And at this moment in time, this could have just been a move to push up to potentially take us up to these areas. However, the devil's in the detail, as they say. And if we just zoom down, you can see here, the clue here was that once we broke this low, so we broke the base of all of this, okay, we tapped into it. At this point, we could have seen an impulse back up, a correction, and then pushed higher. But instead, price just corrected sideways. That gave me a clue that there was not enough liquidity under here. And when we retest the back end of this, there was not enough liquidity to send price to the upside. And that likely this was just a impulse correction continuation to push lower, which is exactly what happened. Okay, so you can see here, price impulse down. And we have this little footprint. Price left a footprint again. We have the little FOMO channels. Price near missed to it. It near missed to it again. You can see that we kind of have this. We had this kind of structure here. I'm a bit mindful because we have this kind of structure here, not so much of a middle section, but we hit the base of that structure and price didn't commit to the downside. So this is a failed bear flag, okay? A failed continuation to the downside. We then have this kind of structure and the middle section. Okay, we more or less completed that. Price hits the 90% rule, the start of the structure, but fails to commit. Okay, so the more times this happens, the more cautious we have to be. And then we kind of have this. We don't really have a first touch, but we have this kind of structure here. We have the 1, 2, 3 middle section. Okay, and price looks like it's just pushing up to give us that 1, 2, 3 to tap into that area of value that we keep near missing too. So what I'm going to be looking for in this instance is I'm going to be looking for price to tap into that area. And because we're nowhere near any of these other inflection points, what I'm going to be doing, and because we've kind of reacted from, if we're moving to the upside, we've kind of reacted from nothing on the left, nothing of significance. What I'm going to be looking for is a tap into the area of value, followed by a push down, and then I will be happy, as with Aussie Kiwi, to take a 5-minute continuation on the break, or a 15-minute continuation, where I would look to get short either within the flag or on the break of it. Okay, once again, filtered on the 5-minute chart just to see if it was structured. That's what I'm going to be looking for from Kiwi dollar. I like that a lot. These are 2 low risk positions, okay, because it would look very, very odd for price to just tag me in and then tag me out and move to the upside when it's kind of reacted from nothing on the left. If it was going to look to get long, and given all of these other factors, the reversal structure, the tap into the area of value, the dropout, all these other factors, and the fact that there's not really anything above price until all the way up here. Okay, so this makes this a low risk position. So that is what I'm going to be looking for from Kiwi dollar. Kiwi CAD, however, a slightly higher risk position because of the fact, if I just zoom out, you can see that we kind of, let's have a look. So we tapped into this area of value, we moved to the upside aggressively, we tapped into this, moved to the downside. However, in this instance, you can see we have a near miss to here. We even have a near miss to here. So this is kind of a momentum play, but it wouldn't look too abnormal, even though I'll be looking to get short, if price was to push to the upside to take out these highs, because of, in particular, of this near miss to here, this near miss to here. Okay, so if we just drill down, so you can see once again, very similar as with Kiwi dollar. However, Kiwi dollar has actually tapped an area of value and an area of significance, whereas Kiwi CAD hasn't. It near missed to it, which makes this higher risk. Okay, so I'm just looking to capitalize on an impulse correction continuation down to here, where potentially we may reverse from there, because if we measure the legs, so if we measure it from there to the base and there to there, that lines up almost perfectly with there. Okay, and then potentially we may move from there to take out those highs which we near missed to, which would leave us with this kind of structure here. It doesn't have to be precise, just the overall structure. And then we would have an impulse up, corrective middle section, slightly more corrective middle section, and then I would expect that wave up to there, if we did move up to there, to be very impulsive. So because this is slightly higher in risk, this position, and because I don't take higher risk positions until I'm up by 2% for the month, I'm currently at break even for this month. I did take one trade recently, but that was on the last day of the previous month. So because I'm not up by 2%, I'm not taking higher risk positions. So I will not take this position unless one of the other two setups gives me an entry and puts me in profit by 2% for the month. Okay, so it's very important to have a game plan. Okay, now also we have to factor in, we're creating, so we have that kind of structure here again. We have that with the middle section. We kind of hit the 90% rule, the start of the piece of structure, and we don't commit. Okay, that's a factor in my thinking. But if we're moving to the upside, we've kind of reacted from nothing here at the moment, so I'm not too worried about that. However, what we do have is multiple highs here. Okay, so if I was to look, if price was to tap in here, for example, tap into here, and we got a flag there, I could easily be tagged in and tagged out by virtue of the fact that we're actually retesting all of these highs. So how do I mitigate that happening? Okay, to make this a slightly lower high risk position, if you like. Okay, well, quite simply, what all we do is I would look for price to tap into the area of value. Okay, this is the start of all of this structure. So I'd look for price to tap into the area of value, push down, and in this instance, I'm looking for a push down back, a push back down below this area of inflection. Okay, and then we've mitigated. If we get a correction underneath there, we've mitigated the chances that this, is just that to tag us in, tag us out, and move to the upside. If price does this underneath here, then that's the confirmation that this was not a retest of these highs to go long. Okay, but because it's a higher risk position, I would be looking for a tap into the area, a 1 hour impulse down below the area of inflection, so there. But I would not be looking in this instance for a 5-minute continuation. So I won't be looking for 6 to 8 corrective 5-minute candles. I'll be waiting for slightly more weight, which would be a 15-minute continuation. So a 2-touch 15-minute continuation as a minimum. So 6 to 8 corrective 15-minute candles. And then I would look to filter that on the 5-minute chart with for the risk entry within it, or reduce risk entry on the break. And then I would be able to manage it down to here for something in the region of 2.5 to 3%. And then I would use the mechanical management system again, and I would measure it from range to range. So from this range where we reacted to, but admittedly near missed to, and I would, in this instance, I would set a take profit at that low there, just above this 90% mark, because this was a sharp move where price might react from, and we don't want to give too much profit back to the market, even if price does continue to the downside. That's what I'm going to be looking for today, folks. I hope you've enjoyed this video. and I will catch you again in the next one. Thank you very much indeed for watching.